Cheers, guys.
Okay, Jamie, welcome back to F.A.C.E. You have fans here.
I heard. Very kind words. How much did you pay them?
Well, we don't. We
Not
have
enough.
shills. We
Not
have
enough.
shills that work for free here, Jamie. Okay.
One second.
Anyway, great to have you back, Jamie. And
great to be here. Thank you very much.
Yeah. So I wanted to start off with some of the things I've read in your feed, and you're talking about the terminal rate, and maybe you could explain to our viewers what is the terminal rate and how the forecast has been changing lately.
Yeah, well, the terminal rate is what we call, or what we deem to be the, excuse me, slight cough, is what we deem to be the rate at which the Fed will raise the federal funds policy rate over the course, basically the peak rate of the tightening cycle. And that's obviously hugely important for financial markets because it tells you how quickly the Fed will tighten, how aggressive or not, and when that rate will be reached according to market expectations. And obviously these expectations shift. They move quite quickly, sometimes very rapidly indeed. And basically what I've been looking at is not just the level of the terminal rate, but when it will be reached in the eyes of the US money markets. And also the looking beyond the terminal rate as to when the market thinks the Fed might start easing policy. And it's been quite interesting since the Fed's decision, policy decision in May, in early May. We have seen on that day, I think it was May the 4th, the FOMC day, the terminal rate as implied by SOFR contracts spiked to 3.48%. Let's call that 3.5%. So that day, the market was thinking the Fed was going to raise rates to 3.5%. And the timing of that was deemed to be around about June, September next year. Since then, it's been very interesting. That the implied rate, again, this is all just implied what the market is betting on, and we obviously don't know. The implied rate has since fallen, and it fell as low as about 2.8% in late May, and we're now hovering around 3.2%. So you can imply from that since the Fed's meeting last month, the market has removed about 25 basis points of tightening in the cycle. And interestingly, as I said there, that terminal, the timing of when that terminal rate, or when the Fed would peak in its tightening, was deemed to be around about September, June, Q2, Q3 next year. That has gradually been pulled back to June, a very firm bet on June. And actually, in the last week, 10 days or so, there was a very brief moment where the March implied contract, with implied rate for March 2023, was higher than the June. So basically inferring that the Fed would actually peak in March. Now that's quite a rapid tightening of the cycle. It's a shortening of the length of the tightening cycle. So if you think that the Fed is going to be in max out in March next year, that's very important for financial markets. And the back end of next year, we started to see a widening of the spread between March and June versus December. In effect, the market is now pricing that the Fed will reach peak rate round about just above 3%, sort of the middle of next year, and actually almost fully priced in a cut of 25 basis points in the back end of next year. Now, take from that what you will. To me, that shows to me that the market is buying into the Fed narrative that they're going to press ahead with rate hikes in the short term, but the price of that will be, it will be paid in terms of the growth outlook. And recession risk is still quite small, but I think the market is starting to price in the likelihood that growth will certainly slow. If not, the economy could tip into recession, and the Fed will be forced to cut in the second half of next year.
Okay, so is it possible that the Fed is just playing catch up with a 10-year rate that already traded 320?
Yes, most certainly. But as you've also seen from the 10-year, the 10 years didn't stay up at 320 for long, did it?
No, that's right.
It hasn't stayed above 3% for long. I think we're back down at 295 or so. We certainly were on Friday.
297 now, if you look at
297.
my
Well,
screen.
Yeah. And the curve has started to steepen slightly. I think last I looked, we're about 27, 28 basis points in the 2s, 10s. So, I mean, some positive sloping in the yield curve is now back in play, and it has been for a few weeks. But again, you may not want to read too much into that in terms of the growth outlook and future Fed policy, because, you know, as we all know, the curve inverted, however briefly and shallowly, if that's a word, in early April, I think it was. We got about 5, 6, 7 basis points of inversion over a couple of days, and boom, we were back positive again. But as we all know, despite some of the protestations from Fed officials, including Jerome Powell, that the 2s, 10s is no longer a leading indicator anymore, certainly in the current environment of, you know, major central bank stimulus.
If they don't like the message, they change the indicator.
They did. Powell focused on, I think it was the spread between the sort of 3-month rate and the implied 3-month rate over the next 18 months. So a very short-term snapshot of the curve. He preferred to look at that. Other Fed economists in working papers have put out papers saying that maybe the 3-month 10-year is a more accurate guide. But you know, facts are facts. The 2s, 10s has been pretty reliable over the last 40, 50 years.
Yeah.
Ignore it at your peril. I think we discussed this last time as well. I would say ignore it at your peril. This time it may be different, but it may not be.
You know, and bond is a big word, right, Jamie? And bond, because there's so many different stripes of bonds. And I was wondering if you could help me with this and tell me if my interpretation is correct. I see the sovereigns here, using TLT as a proxy, looking to be the weakest. They had the weakest rebound here, followed by the corporates, which had a better bounce and are holding up here. And surprising to me, the one with the best relative strength is high yield or junk. Is this saying that we're probably okay for risk on for a while, or this would be underperforming sovereigns and corporates, that the high yield market is getting the bigger bid, much bigger bid than treasuries? Here's the treasuries, much bigger bid than treasuries and corporates. What's the message with high yield being the relative strength of debt? Well,
it typically is, as you know, in times of growth risks and downdrafts across asset markets, credit gets hit pretty hard, and especially high yield. And high yield is usually one of the first to go. That hasn't been the case this time, as you point out. I think last I looked, US high yield I think the spread was only around 400 basis points.
Yeah.
And, historically speaking, that's not much at all, is it? And that spread of 400 or so is only around 140, 150 bips above the cycle tights. So that would suggest that certainly as far as the credit market is going in high yield, there's very little recession risk being priced in there, and there's it seems to be giving you a bullish signal, and certainly risk on. But the flip side to that would be maybe these growth expectations haven't been priced in yet. Even on the short-term rates contracts and the bond market and the treasury market, as we were just discussing, yes, 25 basis points of easing is being priced in for the back end of next year, but it's not being fully priced, and it's only 25 basis points. So you could argue that maybe the market is not going all in on a US economic slowdown and a major response from the Fed.
Yeah, I found that interesting. Yeah, just the price action, that it had so much more energy than.
Yeah, no, I think it's been quite remarkable the way that the high yield market has held up. That may start to shift as growth and earnings expectations maybe get revised down. Perhaps these earnings expectations and default risk expectations are still too optimistic. The fact there was a note from HSBC out this morning just talking about that, and they were saying that their argument was that you should probably focus on the downside risks to growth and earnings over the more attractive valuations. Now you can,
Yes.
you pay your money, you take your choice.
I've heard
on that
they haven't really priced in the earnings reductions, which they believe or compression, that part of the decline.
Well, it's interesting on the earnings, on valuations. There's no doubt that they're much more attractive now than they were, you know, 2 or 3 weeks ago.
Valuations, yes.
Yeah, sorry, stock market equity valuations. Yeah. S&P forward 12-month Ps are, I think they're back in line with, you know, the 10-year average, and they're below the 5-year average, which might suggest, you know, now's the time to get back in. But then you have to bear in mind also that the last 5 years, they haven't been a normal 5 years, shall we say. We've had major fiscal stimulus and Fed stimulus, and that was even pre-COVID. And then I'll throw on top of that the huge double whammy of stimulus in the pandemic over the last 2 years. So maybe you shouldn't be comparing your 5-year average to the last 5 years, because it's been a very abnormal 5 years.
I'd say 99.9% of analysts and traders out there are calling this a bear market rally. And maybe, you know, we go to 43, 44. I would say any lone wolves out there are saying that we may have put in the bottom or going to new highs. I don't hear anyone talking like that anymore. Do you?
It's hard to say. I think it's safe to say, you know, obviously without naming names, that equity strategists are famous for clinging on to their views until the last possible second. I mean, I remember at the start of the year, in sort of January, well, obviously when all the big shops were putting out their year ahead outlooks, they were pretty much to a man and a woman bullish on the S&P. It was, you know, not super bullish, but, you know, 10, 15%, you know, gains forecast for the year. And as Fed's hiking expectations, you know, think back to January when we had Jamie Dimon and Bank of America coming out with 7 rate hike calls. I mean, many people thought they were, you know, off their rockers, but here we are. 7 has that proved to be accurate. As those tightening expectations got priced into the money market curves, the rate curves, and the bond market, equity strategists still held on to their bullish, you know, 10% gains for Wall Street until it was patently obvious that
April was the decider.
I think so.
So
they'll be the last ones to
turn bullish again.
Probably. I mean, if they've gone bearish or drawn back their bullish calls now in the last couple of months, I think it'll be sometime before they flip back again.
Yeah. Okay. And is the U.S. your beat or global beat? Could you comment on what you think the RBA might do this week?
I think the RBA, like everyone else, is in full-on hiking mode and inflation fighting territory. I mean, yes, my beat is global and but US being the focus, of course. But I think you mentioned it in your discussion before I came on. What's super interesting for markets this week will be the ECB. Now, and again, one of your panelists before was talking about people not believing that the ECB would ever hike rates ever again. And as you also said, I've been doing this. I've been around the block for a few years, and yes, that was the vibe, that was the narrative, and you know, it built up when Draghi, you know, said he'll do whatever it takes. They cut rates to zero, then they cut rates to negative. You know, trillions of QE and monetary stimulus. And there was a deflation problem or the risk of deflation in the Eurozone. Obviously, that's completely flipped in the last 6 months or year. And they're now facing an inflation problem. And this is very much uncharted waters for the ECB. And dare I say, much of the market trading it. Do you believe the ECB when they say they will raise rates by 25 or 50 basis points? For veterans in the market, that's a very hard pill to swallow, because
the market still doesn't believe Lagarde will do it, do they?
I don't think so, and I think, you know, there's good reason for that. There's very good reason for that. Those of us who were around in 2008, July 2008, and 2011, I think it was, when they tried to do it again, tried to raise. You know, these were, you know, history has shown that to be, by some estimations, some of the biggest policy errors in the last 10, 20 years. And so if you were around then, do you think that they will go for third time lucky? They may have to, just because of the inflation problem, but they will not be doing this easily.
Okay, so that's going to be a real big tell for the market here. Do you think that what we've had here so far, Jamie, in the dollar, we had a pretty nice pullback, just like we've had a nice rally in euro. Are you feeling a shift that maybe the dollar might be losing its interest rate differential edge as part of this?
That follows seamlessly from what we just talked about there, the ECB. I mean, some of the pricing, the money market pricing into the Eurozone curve for this year is nothing short of remarkable. 130 odd basis points of tightening priced in by the end of the year. Bank of America today saying they expect 150. I mean, for a central bank that, as we just said, has been guilty of perhaps two of the biggest policy errors in recent central bank history, they've been at negative rates for years and years and years. To suddenly go from that to 150 bips of tightening in the teeth of what may well be an economic recession
because of the energy issues.
The energy issues, the geopolitical issues right on its doorstep. I mean, that's a pretty bold call. I think that's a pretty bold call. Will they follow through? Only time will tell. But I think some of that pricing may come off in the second half of this year, in the back end of the year. However, we are where we are, and there's no doubt that part of that dollar pause that you just mentioned, it's definitely lost a bit of steam. Maybe that was always going to be on the cards. It was at a 20-year high on an index basis only a few weeks ago, and so if you compare, I think all the Fed tightening, as we also discussed, has been priced into the curve. Now next year we're starting to price in a Fed easing, and the ECB has gone in the opposite direction. We're now pricing in aggressive tightening. So that explains why maybe we didn't get down to parity, and we're probably just as close to 115 as we are to 1-to-1 with the dollar now. I think we're in a kind of wait and see mode on both the dollar and the euro in terms of central bank direction. I think the ECB is the big one this week. They won't do anything, of course, but they'll lay clear foundations for their policy path for the second half of the year. And
do you think
will they be as aggressive? I think it's absolutely fascinating. I'm still not sure. Maybe once bitten, twice shy, and all that. But I would be surprised if they follow through with, say, 150 basis points of tightening in 6 months. That would be remarkable.
Okay, so still believe that it's just words and actions are different than words. So
as we all know, central banks have to talk tough on inflation, and part of their job owning and their guidance maybe let some of the market do the work for it. If they get the euro back up to 110 or above, I think one of your panelists said maybe 112 might be on the cards. If they get the euro up to 112, then that's nearly 10 big figures higher than when it was only 2 or 3 weeks ago. And I think they'll be quite happy with that. Obviously, the inflation dampening effects that has and the signal it sends is, I think they would be happy with that.
How about the Fed? Would the Fed embrace a weaker dollar? I know that many multinationals that started talking about the strong dollar being a headwind on profits would welcome it. Would the Fed welcome a weaker dollar? Embrace it?
Welcome or embrace might be a little bit strong, but I mean,
give it a kiss.
I don't think they would object if the dollar was to come down, say 5%, 5% from where we are now. And again, it was only a few weeks ago that the dollar on an index basis against the world's major currencies was at a 20-year high. So, some sort of, if some steam comes out of that balloon, then I don't think that will do the Fed any harm. And I think the dollar was so strong in the last few weeks that I think the G7, I think we had the G7 summit a couple of weeks ago where I think they mentioned in the communique a commitment to. I think they did mention foreign exchange rates. There was some speculation building going into that policy meeting, that G7 meeting, that the Japanese certainly would press Yellen and Powell on the dollar. And I think behind closed doors,
let's talk about the yen. We're almost at new highs after, which means a weaker yen, right? And it correlates pretty tightly with the 10-year yield, right? And the 10-year yield doesn't have the same energy. Here's a 10-year yield. See, the rally is not as advanced as much. I'm thinking maybe 3%. I'm not looking for new highs. And the yen is only about 50 pips away from new highs in US dollar yen, new lows in the yen. So do you foresee anything coming out of the Bank of Japan that could change, what their stance has been for decades?
Well, again, I think one of your panelists referenced it earlier, and if we think that the ECB is famous for easy policy and being ultra cautious and trying to not tighten too quickly or too aggressively in the face of past policy, what can you say about the Japanese? I mean, they're the masters. They've been doing this for 20 plus years. Well, I think.
Is there a problem with it getting this weak?
Well, it's inflationary, but right. I suppose that's what they want to a certain extent. They want to generate some inflation. I think.
Okay.
It's not just the Japanese, of course. All the central banks are in the same boat now. It's a complete 180-degree turn from the past, 10, 12 years. They want inflation, and they want a stronger currency. They want higher rates to try and to damp down inflationary pressure, certainly in the Eurozone and in the US and the UK. Japan's slightly different, of course. But I wouldn't bet against the Bank of Japan. If the Bank of Japan says it's going to double down on yield curve control and keep policy easy, I wouldn't bet against that. And obviously, the FX trade there is go long dollar yen. However, dollar yen's had a pretty good run in the last 6 months, and it might be to go long at 130.
A little late to the party.
Possibly.
Yeah. How about energy? WTI. The Biden administration's trying to patch things up with the Saudis. They came out with they'll pump another 2, and then Russia comes out and says they're going to cut production. We haven't made new highs for a long time. The majority of people would say, new highs coming, 135. Is there anything that politically OPEC and, actually walk the talk, actions louder than words, where they could come in, and if they come in and raise production, that other countries might, to take this crude back down to the bottom of the base now? Is there anything in your on your radar, Jamie, that says there is a possibility for WTI to sell off? Or is it all one way?
Well, obviously, the more supply comes on the market, the obvious pressure on that on the price would be to push it lower. But I don't really see that just yet. I'm just looking at a chart now of WTI over the course of the last 6 months, 9 months. It looks pretty much. I'm no chartist, but what I see in front of me is a very bullish chart.
Yeah.
And I don't see any pullback that we've seen in the last 6-9 months has been very brief. There was that pullback round about, from what 100 and was it 140 odd? Sorry, about 130 down to about 115. Yeah. Then it went back up pretty rapidly. I think if OPEC does come out, I'm not sure of how much capacity it has to increase output, but I think the pressures are certainly on the spot market. I think the prices are pointing upwards in price still. However, from a macro point of view, it doesn't
demand destruction.
Well, that's true, and we've seen I think here in the States we've got all-time high average gas prices. That's bound to bite, and that's bound to have an impact on demand going forward. And if the economy does slow in the second half of the year, early next year, as people expect, and that's going to weigh on prices too. But from an inflationary point of view, even if oil does stay up about $100, $110, $120 a barrel for the next 6, 12 months, the inflationary impacts on that aren't going to be particularly strong because that's where the price has been for the last 6 months. So the increase has kind of flattened out. Right. So policymakers won't be as concerned with these high oil prices from an inflationary point of view over the next 12, 18 months as they might be from a demand point of view.
Okay. Jamie, your forecast for what the Fed's going to do next week and forward guidance?
Well, I think they've all been. They were all out last week, weren't they? Daly, Mester, I can't remember who else. I think Brainard was the most interesting, perhaps. Being vice chair, she said she wouldn't rule out. I think I'm right in saying she said she wouldn't rule out a hike in September, and because Atlanta Fed President Raphael Bostic, he'd suggested that they might pause in September. Now, Brainard, obviously one of the biggest doves on the committee, she said there's not much. She doesn't see a case for a pause, and she would press ahead with a hike in September.
Will 50, there be a surprise of 75?
Well, this is it. We've not had a 75 basis point hike since 1994, and before that was 1984. So it's one 75 basis point hike in nearly 30 years.
Yeah.
It would be a brave call to say 75. I think all the messaging, all the signaling is for 50 at the next meeting and the next one. And then we'll wait and see. However, I think the balance of risks would be certainly towards 75 as opposed to 25 over the next 2 meetings. But I'm still again going back to the SOFR implied pricing. That hasn't changed much. As I said, the peak terminal rate was 350 for the middle of next year. That has come down since the Fed meeting in May. That's come down. I think that's worth bearing in mind. So while the Fed's talking very aggressive, it's looking like it's going to be more of a 1994-95 hiking cycle. Very short, pretty aggressive, but maybe over 12 months, say, for example, 18 months max. But that will, as I said, the price of that will be in growth. And we've had even Jay Powell has said, he's gone from saying we're confident of a soft landing to a soft-ish landing. And his last comments were, there may be some pain, quote unquote. So I think he's
put on your crash helmet.
So right. I think it's quite clear that the Fed is going to go ahead, tighten, try to get inflation under control, inflation expectations under control, but be warned, the risk of that or the price of that will be some economic, and in his words, pain.
Pain. Okay, well, I have a doctor, his last name's Payne, P-A-Y-N-E. Actually, so Jamie, I really appreciate your time, and people, viewers watching live, if you really want to know what's happening economically and with the Fed, and as you can see, Jamie covers everything. Follow him on Twitter at Reuters Jamie McGeever. Thank you so much for your time. We covered a lot of ground in half an hour.
Thank you very much, Dale. A pleasure to be on, and all the very best.
Okay, we'll be doing it again, everyone. People are thanking you, Jamie. Appreciate your giving spirit to share your views, and I know that you do a lot of work to come up with your insights and what you write about. So it's not easy being, gathering information the way you do it. Thank you very much.
Appreciate it. Thanks again. Speak soon.
All right, Jamie McGeever, everyone. Have a great day. You're welcome, Ann, Karsten, thank you, Jordan. And you could join the team in 13 minutes on the Morning Edge. We'll see everyone for Turnaround Tuesday. And remember, don't just count your pips, count your blessings. See you all tomorrow. Adios, and thanks again, Jamie McGeever.
Ciao. Have a good day, everybody. Bye.
Hey, buddy.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.